Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to the calculation of degree of operating leverage, degree of financial leverage, and combined leverage. This is going to be part one of a two-part presentation for these calculations with relation to leverage. We're going to be focusing in here on the degree of operating leverage, and then in a following presentation we'll go into the degree of financial leverage and combined leverage. This will also be one of two similar problems. So this is one of two similar problems, part one of the first similar problem, part one of two parts of that problem. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 520 degree of operating leverage, degree of financial leverage, and combined leverage tab in the practice problems section. Going to be closing this back up. We're going to have our information. We'll go over all the information up top, and then we'll see a smaller portion of that information as we work through the practice problems. Remember, here we're going to be focusing in on part one of a two-part problem, and that then is going to be focusing in on the degree of operating leverage. So we have our income statement. This is going to be A for we'll have an A and B kind of scenario. A income statement where we have the sales, we have the units, and then we have the unit price. That gives us our total sales. Now we're in a contribution margin type of income statement, organizing the income statement in terms of the sales minus the variable costs, giving us the contribution margin as opposed to what we would see in a normal income statement, which would start off typically as sales minus cost of goods sold, giving us the gross profit, and so on and so forth. Remember that the contribution margin income statement, very useful, but only would be had from an internal perspective. If you're looking at the financials from an external standpoint, meaning the financials of a company that they're provided externally, they're only required to give normal kind of financial statements, and then you'd have to adjust them in that case. If you're internal to the company, quite often, then we'll take that same financial information, convert it into a contribution type of format so that we can make projections into the future. That's the assumption that we make here. Also note that when you're looking at leverages from an outside perspective, then you may be able to generate some of these numbers from financial statements, make some assumptions about them, or you might use an alternative method in order to do some of the same calculations. We'll talk about that a bit as we go as well. So then we have the variable cost. That's going to be the units times the unit cost. That's going to give us the total variable costs. And then, of course, if we had a subtotal here, it would be the contribution margin total, but we're just going to take the sales minus the costs, total variable, and the fixed cost to give us the earnings before interest and taxes. Then we're going to break out the interest separately as we do in a normal kind of income statement. And then we're going to have the earnings before taxes only. Then we have the income tax expense, and that's going to give us the earnings after taxes finally. We have a smaller breakout of our information here. So here's our income statement so that we can kind of go back to it a little bit more easily. We have our calculation. We're going to be focusing in on the degree of operating leverage here. Now you can see this calculation multiple different ways. And like I say, there could be some alternatives, and it might depend on the type of information you have as to which calculation you may use. The top portion are basically three ways of saying, in essence, the same thing. The bottom one is basically that alternative kind of calculation. Notice the top one is going to be taking into consideration the contribution margin terminology, which will be used on these contribution margin type of income statement. Something that you will typically have if you're internal to the company, if you have access to the data itself, something that you may not have as much access to if you're external to the company, looking at publicly produced financial statements as, say, an investor or something like that. You could then kind of back into this information if you're in that standpoint, or you might use like an alternative type of method to try to get to a similar endpoint, such as this calculation here, percent change in operating income divided by the percent change in sales. Our focus is going to be up here first, and then we'll talk about this second way that we can calculate this at a later point. Now, if we focus up here on the first one, there's kind of three ways we could say the same thing in terms of this equation. Now, the easiest way to memorize it would be to take the contribution margin over or divided by the operating income. But then we want to be more specific about what that means. If you memorize that, then you got to memorize what the contribution margin means and what the operating income means. So you want to memorize this thing in chunks and basically understand what the division problem is here, and then have a deeper understanding of what it means to be contribution margin and an operating income. So the contribution margin, the second way we can think about it is contribution margin here. Operating income typically often calculated as the contribution margin minus the fixed costs. So if you have a contribution margin income statement, then you'll typically think of the contribution margin minus like the fixed costs. That would be basically your operating income. In a multi-step income statement, in a normal multi-step income statement, you might simply have just the operating income, right, broken out, or you might have to back into it if you have a single step income statement or something like that. But that is that. And then we're going to have the calculation. You could think about it this way in terms of a formula, which would basically be calculating the contribution margin. There's a couple ways you can do it. You could take the total contribution margin minus the total variable cost, or you can take the unit price minus the unit variable cost, which would give you the contribution margin per unit, and then multiply it by X being, in this case, the units, right? The number of unit sales we have, divided by the contribution margin, same first half of the formula, that's just calculating the contribution margin again, minus the fixed costs. So we're going to be kind of focusing in on this formula here, but I would memorize it in terms of either this format or this format, and then understand what the numerator and denominator mean. We're going to do this in our calculation that's going to be kind of like a tax calculation. Again, most people will represent this in terms of plugging these numbers into this little formula and then calculating it. I think it's useful to break this out in kind of a expanded, like if we were going to make a tax form out of this and do each calculation on a step-by-step basis. So I think it's useful to do that here. It's also useful to do it in Excel, and I highly recommend working these problems in Excel. We do have access to those as well. So what we're going to do is, at the end of the day in our little worksheet over here, we want the end column to the furthest right to result in the numerator and the denominator, contribution margin over net income, and then we can simply divide them out. Any internal kind of calculations we will then do in the inner sections of them as we go through our little worksheet. So that's how we'll set it up. You can imagine like putting together a little tax return, or type of calculation for some calculation that needs to be done on a tax return or something. So we got the contribution margin, colon, that's going to be the units sold. That's going to be X in our calculation. That's how many units we're going to sell. And we have the 26,000 units that we're taking from our information up top, the 26,000 units. We're then going to take the contribution margin per unit, calculating that. That's going to be this little section, P minus VC, which is the price, unit price minus the variable cost per unit. That's going to give us the price. We're going to say is the 72 given up here, 72 minus the variable cost gives us the 36 variable cost per unit given in our data here. That's going to then give us our contribution margin per unit, which is now 36, 72 minus the 36. And then we can calculate our contribution margin, which would be the 936, which would be the 26,000 units we're going to sell, times the contribution margin per unit gives us the 936,000. So that's going to be our calculation here. We took this 26 price minus the variable cost. Then we did in like an expanded format. Now note that this 936, it just so happens that the data that was given to us, we could have pulled it directly from here. The total, total contribution, well, actually, it happens to be the total variable cost, but the contribution could have been calculated directly on our contribution margin income statement by taking the sales total 1872 minus the variable cost 936,000, which would be that 936,000. That we could another way we can calculate the same thing. So a couple different ways we can get to that same number, but bottom line, we're at the total contribution margin. Don't get it mixed up with the unit contribution margin as we have here. This is the total contribution margin. That's our numerator in our formula. Let's look at the denominator, which is going to be the contribution margin minus the fixed costs, otherwise known as the operating income. Two ways to get to the same thing. We're going to say, all right, if I pull that number out, I'm going to say the contribution margin, same number here. That's because this formula and that formula are the same component. Now we're just going to subtract out the fixed costs. The fixed cost is going to be 460,000. We get that from our data up top. The fixed cost 460,000 right there. And that will then give us then our contribution margin minus our fixed cost, so the 476,000, which is kind of like our operating income, which on a normal income statement, you would typically see that in a multi-step income statement. We also could have just simply gotten it here by picking up this $476,000 from our contribution margin income statement. So again, if they give you a number, you might have to kind of back into that a few different ways. If they gave you the net income, for example, then you basically would need to add back in the taxes and add back in the interest to get back up to basically operating income, which often is called, or could otherwise be called, earnings before interest and taxes, or could be labeled as contribution margin minus the fixed costs. So that's why these labels can be, you got to understand what the labels mean to some degree to get this stuff. And then we're going to say, all right, that's going to give us our degree of operating leverage. We're now in the outer column where we have the numerator and denominator now in the outer column, being the 936,000 divided by the 476,000. That's going to give us our 1.97 about. We have to deal with rounding all the time when dealing with these types of calculations. So once we have that, we could start to think, okay, well, what does that tell us? That's the degree of operating leverage. And leverage, like anytime we think about leverage, often people think about, of course, financial leverage or leverage related to debt. And so this is another kind of leverage, but it acts the same way in that the higher the number is, the more leverage there is. The more leverage there is, the more risk there is, but there's a trade-off between risk and reward. If you have more leverage, it's possible that if things improve, if good times happen, things are going up, you could have a multiplier effect and have an increase due to the leverage that you have. If things go bad, things start to go down, you could have a multiplier effect on the impact of the amount of the decrease that could be taking place. Now, what is it, the thing that is causing the leverage here? It's not the debt, it's the fixed costs. It's the relationship between fixed costs and variable costs. Fixed costs, having a high amount of fixed costs versus the variable costs, is more risky, and it acts in a similar way as you can think of basically as debt. Why? Because if times go up, the fixed costs don't move up, right? The fixed costs stay fixed, which means that could kind of have a multiplier effect on the good times. Whereas if times go down, you still have to pay the fixed costs. So in other words, if you are paying the rent on the facilities, if times go up and you have more sales, then you're paying the same fixed costs, and that could have a multiplier effect as things increase. But if there's bad times and sales go down, you're still paying the same rent on the facilities, and that could have a multiplier effect on the amount of the decline that could happen, as opposed to if you had most of your costs up here in variable costs, because when times go up, they're going to increase, sales go up, but so will the costs in relation to the sales increase. So that's going to have a less of an impact. That'll be a benefit, that'll be good, but your costs are going to go up at the same rate, so it might not be as effective. If costs go down, however, if the sales go down, your costs will go down in relation to it, and therefore you're not going to have as bad a time in a declining time. You won't have the multiplier effect. So the risk here is with the fixed costs. The greater the fixed costs are in your cost allocation, the higher your degree of operating leverage will be. Also note that as you move away from the break-even point, your fixed costs, your leverage, the degree of operating leverage will tend to decline as well. And that's because, once again, the ratio or the breakout between the fixed costs and the variable costs will be lessened as the sales go up. Why? Because as sales go up, your variable costs are going to keep going up, right? So the variable cost total of your cost structure is going to be higher in relation to your fixed costs, because your fixed costs will remain the same. Also, just note that some companies are going to be in areas where they're going to have more leverage in terms of operating leverage than other companies, meaning they're going to have to just pay for larger amounts of fixed costs. So when you think about fixed costs, you got to think about the type of industry that you're in terms of what the fixed cost structure will be in that industry, and that will mean that some industries will just be inherently more risky due to the high level of fixed costs that might be in a particular industry. So another nice little feature of this degree of operating leverage is we can kind of take a look at an increase in sales and jump to exactly what we think the increase in the income before interest and taxes will be. basically the operating income. So for example, if we say that there's an increase in sales of 10%, we think the top line is going to increase here. Either basically we could say that the amount, we could say that the sales are going to increase. We're going to sell more units. Let's say it increases by 10%. We can multiply the 1.97 times that 10%. That's going to give us an increase in earnings before interest and taxes, or an increase in operating income of 20%. We can jump right. So that's going to give us our estimated earnings before interest and taxes of that 569.6. How do we get that? We could say, okay, and I'm going to make this a little bit more exact because this is rounded. So if I take this 936,000 divided by the 476,000, we get more exact 1.9663. And then if I was to multiply that times the 10%, the 0.1, we're going to get now about 20%, right? About 20% increase. And then if we go back up top, I'm going to say, all right, well, if I took my earnings before interest and taxes, basically operating income, times basically a 20% increase, or a 0.1966 whatever increase, I'm going to take this number, this about 20% increase, plus 100% to increase it 120% plus 1. And that's going to give it, and then I'm going to multiply that times the earnings before interest and taxes, the 476,000. That's going to give us our increase that we calculated here of the 569.6. So let's prove that by recalculating our entire income statement now. So we're going to take our income statement, but increase the sales by the 10%. And we should see a bottom line increase in the earnings before taxes or operating income of the 20% about to get us to that 569.6 here. So let's just check that out. What do we do there? We're going to say, all right, well, here's our prior income statement. We're going to increase the units by the 10%. We're going to say, okay, 26,000 times an increase of 10% times 1.10, 110% to increase it by the 10% would be, now we're going to say the units are at the 28.6. 28.6, if I multiply that times the 72, is going to give us that 2,059,200. The variable costs will change in relation because the variable costs will change. The units times the increase in the units is now going to be applied here times the unit cost, giving us the total variable costs. Then if we take the sales minus the variable costs and the fixed costs having not changed here, we're going to get the earnings before interest and taxes at that 569.6. That 569.6 is the same 569.6 we calculated here. So a nice quick way for us to see the kind of like the bottom line number using this. So also just note that if we were to kind of check out this increase now, what's the percentage increase? The normal calculation for the percentage increase would say, here's the new number, here's the operating income that we got now, here's the prior operating income, which was up top here, the prior operating income, 476,000. If we take the difference between those two, that's going to give us the change of the 93.6, and we're going to take that change and divide it by the prior period, or the prior amount. So that 93.6 divided by the prior amount, the 476,000, and that's going to get us about to that 20% again. So that's just getting us back to this about 20%, or in other words, more exactly, the 936,000 divided by the 476,000, which was that, right, times 10 to about, right, that 20%. Okay, so next we want to take a look at what would happen if there was a change in the cost structure. Because remember, what this is measuring is what's the cost structure between the variable cost and the fixed cost. So what if we stick to the original number here, this 476,000, which is what we had in the original income statement up top, so that we have the same 476,000, but we're gonna change the cost structure in terms of the variable cost now being at 20, resulting in total variable costs of the 520,000, and fixed costs are now higher at the 876. This would, you would think, cause more operating leverage, because although we're at the same operating income, the fixed cost portion is higher than the variable costs, providing that higher operating leverage, providing more risk, but possibly more benefit in terms of an increasing or beneficial times. So the degree of operating leverage, if we calculate this again, we're going to say The numerator is going to be the contribution margin. So we're going to take the units that are going to be sold at 26,000 units. So same units as our original problem. And then we'll calculate the contribution margin per unit, sales price, which we have the sales price there, same as before, but now the variable costs are much less at the 20. That means the contribution margin is now 52. So then if we take the units times the 52 contribution margin, our contribution margin is now 1,352,000, which is our numerator. And then we calculate our denominator, which is the contribution margin minus the fixed cost. Contribution margin the same. Fixed costs now being higher at this at the amount of 876,000. And if we subtract those out, we're going to get our contribution margin minus the fixed cost, 476. Also the operating income that we could see here, earnings before interest and taxes, or operating income. Then if we divide that out, now we have our leverage calculation at about 2.84. So we got the 1353000 divided by 476000. We've got about 2.84. So of course now, even though our operating income was the same, there's more leverage for this one. Why? Because more of the cost is now being allocated to the fixed costs as opposed to the variable costs, causing again that more risk, but also that possible reward in good times. So if there was an increase of 10% now in sales, top line sales, we would have an increase in earnings of now 28% in the earnings. And that, if we were going to plug this back into our equation, that would be the estimated earnings before taxes would increase by 28% if there was an increase in sales. So in other words, if there was an increase in sales top line number, then we're saying that the earnings before interest and taxes would now increase by the 28%. If there was a loss, a decrease in sales by 10%, then the earnings before interest and taxes would decrease by 28%. So if we were to plug that back into our formula, let's kind of prove that. We're going to put that into the income statement. Once again, we're going to increase the units by the 10%, the sales by the 10%, meaning we're going to take this 26,000 in our new income statement, 26,000 units times 1.1, 110%. Now we have the units at the 28.6 times the unit price, 72. We've got the sales at that 2,059,200 that have now increased now, but the variable costs will change proportionately. But we're going to take the 28.6 times the $20, which is different from our original scenario. Total variable cost, the 576,000, and then we have the fixed cost now at that 876. So now the earnings before taxes is going to be that 611,200, which is what we estimated here to be the 611,200. If you were to calculate that change again, you're going to take the new number, which is that 611,200, minus the prior number, which was that 476, and then you're going to look at the change and then divide out the change, the 135.2 divided by the prior year period number 476, and we see that we have about that 28% then increase that took place. So in other words, in our first scenario where we had less, we had the breakout between the variable costs and the fixed costs, we're leaning more towards the variable costs. If we had a 10% increase in sales, it would have resulted in a 20% increase in the operating income. Whereas in our more leveraged case, we see that it would result in that 28% increase. So we could see that change with the leverage. Now, again, if you went the other way, if there was a 10% loss in sales, or sales went down by 10%, then it would exaggerate that in that we would have a 20% decrease in operating income versus a 28% on the more operating leveraged company.